One of the most important fundamentals of FI is really simply understanding the US tax code. Now, obviously, no short video can give you a full in depth analysis, but it's really important that we have just some sense of how does the tax system work. For so many people, this is a black box where they have no idea. They throw the numbers into TurboTax or give some papers to their accountant and hope and pray for a refund. And that's it, without even ever understanding what is a refund? Why am I getting a refund? Why do I owe money this year? How does any of this stuff work, right? What is the difference between a tax credit and a tax deduction or a write-off? You hear all of these things, and a lot of us don't even know just the basic fundamentals. So this is one of those things, while it isn't super exciting, if you take 30 minutes, you can really get a sense of how does this work. So really simply pause this video and Google IRS Form 1040. So just open that up and just familiarize yourself with, hey, what does this even look like? What am I adding at the top of page 1? What income gets added? And then, oh, wow, I get deductions. So you're not taxed on the top line number. Let's say you make $100,000 combined as gross income for your family. You're not taxed on that and that alone. There are always adjustments to that top line number. First off, if you have other income coming in, if you have dividends or interest or things like that, that all gets added. So you have a total income amount. And then in very broad terms, you get some type of deduction. So for most of us, a couple years ago, the deduction changed. So what's known as the standard deduction was dramatically increased. For 2021, it's now over $25,000 for a married filing joint family. Okay. So $25,000 plus comes just right off the top of your income. So again, let's assume you made $100,000 in gross income. You get to deduct that standard deduction, which every single taxpayer is entitled to. And you're down now to $75,000 of income. Okay. So let's assume that's it. Your return is very simple. It's two numbers, right? A W-2 income and that standard deduction. What you do is, and again, here's just another little piece of homework, just open up another browser tab and just Google federal income tax brackets. Now, I'm just looking at an article from NerdWallet here, and they're showing me, I'm recording this in 2021, they're showing me the federal income tax brackets, and I get to pick, is this for single filers or married filing joint? Those are the two most common. So this also gives you a sense of, okay, how does our tax system actually work? You always hear about tax brackets. So I'm in the 24% bracket, somebody might say. Now, to you, if you've never been familiarized with this, you would think, okay, we talked about that 75,000 number, right? The 100 minus the 25 gets you down to 75,000. You might say, okay, I just very simply multiply 75,000 by 24%, and that's my federal tax liability. But no, that's not how it works at all. We have a graduated income tax system. If you look, again, at this article, you can see that there are tax brackets. It's graduated. So it's the first dollars. We talk about it actually usually as marginal tax brackets, which is that very next dollar. But let's talk about these $75,000 here. So for the first $19,900 of taxable income for married filing joint in 2021, those dollars are taxed at 10%. Then you look at the next, right? $19,901 all the way up to $81,050 are taxed at 12%. So what's so interesting is this $75,000, you would take the first $19,900 and 10% of that, so that's $1,990, and then you just simply multiply the remainder by 12% and add it together with that 1990, and you've got your tax liability. So that is how it works regardless of how much money you make. So if you made $420,000, I'm going through the brackets here, you just very simply apply those next set of dollars to whatever percentage it is. So basically, you're not penalized. There's no cliff, as they would call it. So if you made, let's say 19,901, it's not like every one of those prior dollars are taxed at 12%. No, that's not how it works because it's graduated. So again, those first 19.9 are taxed at 10%. This next set are taxed at 12%, then 22%. So it just keeps on. So there's no penalty. And that's really critical to understand. I think a lot of people talk about deductions. They use this term write-off as if it's some magical thing. But what happened to us here in this example is that standard deduction, that $25,000 plus, that's worth, some portion of that is worth 12%, and some portion of it would have gone into the next tax bracket, which is 22%. In this example, at most, that $25,000 is worth 22%. So that's somewhere in the vicinity of $5,000 in actual tax saved because of that deduction, that standard deduction that the government gives you. But it's not the write-off. That people flippantly use that term, and it almost sounds like free money, as if you got $25,000 off your tax bill. It doesn't work that way. That's a deduction we're talking about. Now contrast that with a credit, which actually is that full reduction. So the most common credit is the child tax credit. Now, in our example here, we're saying this couple doesn't have any kids, but if they did have children, they would still go through that exact calculation we talked about, and they'd come down and get their federal tax liability, which is the total amount they owe. That's the total tax owed. And then you would look to credits and see how much in the way of credits do I have. Child tax credit, it's going back and forth because tax law is changing certainly, but let's say it's $3,000 a child. So that is a straight reduction, dollar for dollar, in the amount that you owe. So let's say you owed $5,000 and you had one child with a $3,000 child tax credit, then you would owe $2,000 to the government. Obviously, you can tell a credit is much, much more valuable than a deduction. And then I guess finally, just for this simple tutorial, let's talk about one of the most confusing things is, what is a refund? Why do I owe money? What is all this? And I think this is so commonly misunderstood, but it's really simple. So we just went through that calculation and we got down to, what is your federal tax liability? So that's the total amount of tax you owe the federal government for that calendar year. Now, if you have a W-2 job, you've been paying in, maybe unbeknownst to you, but every single paycheck, you have your gross income, and then there's some tax that's being withheld. So that is being sent to the government just to hold in an account for you, is the way to conceptualize it. So you add together all that money that you've sent to the government to hold on account. That's not tax. You didn't pay tax, right? Theoretically, you could have sent your entire paycheck to hold on account. I wouldn't advise that, of course, but just to give you a sense, like, you could have sent that entire amount and that would have been held on account for you. And then you find out when you file your return, what's your liability. So again, let's say you owe $5,000, but you withheld $8,000 throughout the year. So in that case, you've overpaid by $3,000 because you actually only owed $5,000, but throughout the year you had sent in $8,000, thinking that you might have owed that amount. That's the calculation that your company did. But that results in, hey, I paid the government $3,000 too much. So that's when the refund happens. That's your money. This is not some free gift from the government. It's just your money. So in a perfect world, you aren't getting a refund. If you're someone who's following the tenets of FI and you're saving every paycheck and you're not in a scarcity mindset, then theoretically you would have had that money throughout the year to invest. Obviously, many people love getting their refund, and I understand that. It's one fell swoop. If you're somebody who's going to benefit from that, then a refund is fine. But in theory, a zero tax return is the best. The final note would be, if you, let's say you had that $5,000 liability, but you only paid in $3,000 throughout the year, that's where you actually owe money with your tax return. So you owe $2,000 in that case. And so it just gives you a sense of, hey, what's going on here? What am I doing? What does this tax mean? What is a refund? What is a credit, a liability? It's not that complicated once you get into it, but you have to arm yourself just with a basic understanding, and that will go a very long way.